pay close attention, because what gold and silver just did this week shattered a lot of assumptions in real time. For months, the echo chamber's been loud. That was the top. It's done. Classic blow-off. Time to exit. But then the market pulls its favorite trick, humbling certainty. Gold and silver didn't just hold the line, they charged. They broke through, and they printed new highs with the kind of force that quiets even the boldest skeptics. And here's what most still haven't grasped. These weren't flukes. They were continuations, confirmations. The market's way of saying, no, we're not done yet. Before we continue, quick ask. If this channel gives you real value and you're done with the copy-paste crowd echoing each other, show support by subscribing and dropping OG John AG in the comments so I know you're locked in. Now let's get back to it. Silver just delivered the kind of week that rarely shows up on a multi-year chart. Even after trimming late-week gains, the move was big. Big enough to remind you silver isn't some sleepy asset. It's a compressed spring, and when it jumps, it resets your entire outlook. Gold, meanwhile, is doing what it does best when the world turns chaotic. It climbs while people debate. It climbs while stocks try to dance. It climbs while central banks smile and wave. It climbs while the masses look away. Sure, the S&P is green, but when hard assets start to lead, the everything bubble doesn't look so invincible anymore. Here's what I want to break down with you today. First, why the 2011 comparison is flawed. That peak came under a different set of conditions. This environment is not that. Second, how I use foreign currency metrics to set realistic price zones, because watching just the US chart keeps you blind to what global buyers already live through. Third, the uncomfortable truth. Buying, selling, and moving metal isn't just about price anymore. The rules can shift overnight, and when they do, price stops being the problem. Access does. So stick around, because that last piece, that's where the board tilts. Also, check the description below. Bonus links are there. A premium WhatsApp group and info on joining the deeper membership tier if you want to go further. Now let's dive into why this week didn't just feel strong. It rewrote a narrative. It blew a hole in the tidy little theory that's been parroted since late December. You remember that December high, right? Chart guys called it a double top. They drew their line, posted their screenshot, and spoke with hindsight confidence. That's it. It's over. But real tops don't play like that. Real tops come with fast weakness, panic, vanishing bids, volatility with teeth, and most of all, they can't reclaim the highs with strength. What we saw, the opposite. Price tapped the ceiling, stalled just enough to bait the "see I told you" crowd, then tore through it anyway. That's not a top, that's a breakout. And yes, the weekly close matters. Intraday noise can lie, but weekly candles, that's where conviction shows itself. That's where the bigger money leaves footprints. Silver's weekly candle was a calendar marker. A move that size in 5 sessions isn't retail FOMO, it's thin liquidity and deep persistent demand. Gold's candle spoke too. Gold loves to break levels, then flip them into support. That's how strong markets build launch pads. Exhausted markets don't do that, they fade. I know what some of you are thinking. What if this is just the final blow-off? Fair, but here's the filter I keep using. Time after the high. When metals really peak, they fall fast. They don't linger politely, they dump hard. That's what happens when everyone's already in and there's no fresh fuel. This time, we didn't dump. We paused, we coiled, then we pushed higher again. That sequence matters. It tells you there's still real buying pressure underneath. Not day traders, not tourists, real buyers. Those who need allocation, need inventory, or need insurance. And here's the part most overlook. Gold and silver don't need popularity to rise. They just need to be scarce. Scarce relative to the demand chasing them. Popularity comes later. Scarcity drives the early move. Now let's talk momentum, because this isn't just some buzzword traders throw around. Momentum is the market whispering, the easy path has changed. It's no longer every pop gets sold. It's every dip gets bought. That shift turns slow climbs into verticals. And if you're watching, hoping for that picture-perfect pullback, hear this. In strong markets, the clean dip rarely comes. You get fast drops, shallow lows, and breakouts that strand the sideline money. That's how bull markets punish patience. Another reason this move matters: context. When equities sit near highs, people assume that's where the real action is. Just because the S&P is posting records doesn't mean it's the smartest place to park your money. Sometimes it just means it's the most overcrowded. Meanwhile, Precious metals might be whispering something far more critical, that the measuring stick, your currency, is quietly losing stability. And if that sounds extreme, think of it this way. When the ruler shrinks, everything it measures looks bigger. That's why comparing assets without factoring in the currency environment gives you a false sense of security. Now here's the idea I want you to sit with. What happens when this isn't just a metals story anymore, but a policy story? Because when decision makers are forced to choose between defending the money or preserving the system, history shows they pick the system. And when the system is protected, the currency gets sacrificed. That's when metals start to act in ways that seem irrational, until you realize it's just math doing its job. Keep that frame in mind as we dig into 2011. The biggest mistake people make is assuming, well, it happened like this back then, so we're due for the same thing now. But markets don't copy scripts, they echo patterns. So why do people keep shouting 2011 every time metals take off? Because they remember how it felt, the speed, the headlines, the rush of confidence turning to chaos in a heartbeat. But memory isn't analysis. 2011 wasn't just a price spike. It was a pressure chamber, built from fear, debt tension, and desperate policy collisions all squeezed into a short period. The world had just been rattled by a financial punch to the face. Confidence was thin, institutions were still reeling, governments were improvising responses, and in Europe, the bond market was throwing red flags that even non-investors could sense. That background mattered, because tops never form in a vacuum. They form when emotions run high, positioning gets crowded, and a shift in the policy mood is right around the corner. So the key question is, are we in that kind of panic-fueled moment now? Not yet. And that's not me saying we're in a safe zone. That's me saying the synchronized global fear that causes true blow-offs is still ahead, not behind us. In fact, the ingredients we're dealing with now, arguably worse. But the timing is different. Back then, there was still a belief that global unity could fix things. There was still faith that the big players would coordinate. Today, not so much. The world feels fractured. Trade is used as leverage. Supply chains are weapons. Access to raw materials is a battleground. That shift from cooperation to confrontation matters, especially for metals. Because gold and silver aren't just commodities, they're confidence barometers. They're gauges of how much faith people have in the current system. And when that faith weakens, metals don't need hype. They just need to be scarce. Let's move to the second major difference from 2011. Interest rates. It's the piece most people skip over because it's less dramatic. But it's fundamental. Big cycle tops in metals tend to come after interest rates bottom and start rising. Easy money drives the surge. The moment rates turn higher, that's often the cue for the party to slow down. Right now, we're not in that environment. Rates haven't decisively reversed. Rate cuts are still on the table. Markets are still pricing them in. As long as that's true, calling a top is premature. Could we see hard pullbacks? Definitely. Silver in particular can drop sharply, even in the middle of a bull trend. That volatility is why it's hard to hold, but a deep correction doesn't equal a cycle end. That's why I've said before, zoom out. We're not at the conclusion of this story. We're somewhere in the early surge. If anything, the latest rally suggests we're moving into the first major phase, right where the public starts to notice, but long before they fully pile in. And that gap matters, because the most powerful moves usually come between, I guess it's real, and everyone's talking about it. Now let's shift into benchmarking, because this is where minds often stretch. Most US investors only see metals through a dollar lens, but the US dollar isn't the whole world. It's just a key player in it. In many other nations, currencies have already slipped in ways Americans are only starting to feel. And when you chart gold in those currencies, something becomes clear. New highs are already old news elsewhere. That's why benchmarking matters. When you compare where gold is now to its past peaks in local currency terms, you get a sense of how far that country has progressed in the inflation-devaluation storyline. If you run that comparison across several currencies, you start to see a range, a forecast window, of what could happen in the US if similar conditions unfold here. So what's the result? In some nations, gold hasn't just set new highs, it's obliterated old records. In others, the last peak is a distant memory. Then you glance back at the US chart and realize America isn't leading this move, it's catching up. That's not an insult, that's just currency math. If your money weakens slower, gold looks stable longer. But if your money starts weakening faster through looser policy, swelling deficits, or broken trust, then that chart doesn't drift, it snaps. Now apply that same lens to silver, and the contrast becomes even sharper. Why? Because silver is more volatile, and because the market is smaller, capital flows hit it harder. In several foreign currencies, silver hasn't just retaken its highs, it's shattered them. In the US, yes, it's rallied, but relative to the global picture, there's still meaningful ground to cover. And that gap, that's where most people miscalculate. Let me be clear. I'm not saying silver is going to moon in a straight line. It won't. It's one of the most emotionally punishing assets you can hold. It will test you. But the underlying drivers, debt expansion, currency dilution, geopolitical rifts, the retreat from globalization, the erosion of institutional trust, those drivers haven't been fixed. And as long as they remain unresolved, the probabilities lean toward new highs, not away from them. So let's talk price zones. If gold is playing catch up to global counterparts, it's time to stretch your mental models. Price levels that once sounded outlandish start to make sense when you overlay a weakening currency and a softening rate environment. Mid-thousands for gold? Not crazy. For silver, triple-digit territory? Not fantasy. In a world where financial demand and industrial consumption are colliding, and where available supply is thinner than most people realize. That said, here's a psychological warning. As prices rise toward those thresholds, the noise gets louder. The pressure ramps up. FOMO takes over. That's why it's so important to plan before the crowd piles in, because once the herd arrives, emotion drives decisions and discipline disappears. Before we move into the access and control section, I want to take a moment to support the community. If you've been stacking consistently, if you've taken profits smartly, if you've used metals to pay down debt or create stability, drop that in the comments. Not to flex, but to encourage the newer viewers that steady discipline works. What's one lesson you wish you knew earlier? And second, where do you see the best opportunity in the next year? Gold, silver, or the miners? Let's talk. I read more than you think. Now, before we hit the section on changing rules, let's address something I keep seeing in my inbox and in your replies, the banking angle. Every time silver moves sharply, the same questions show up. Are the big players trapped? Are they short? Will someone step in and save them? Here's my perspective. In today's version of finance, rescues are normal. When major players feel pressure, new liquidity tools appear, emergency programs, temporary facilities, accounting tricks, all designed to soften the blow. You've seen it before, and you'll see it again. But for regular investors, that's not the real issue. The issue is what those rescues trigger. More currency printing, more guarantees, more temporary programs that quietly become permanent. And all of that, it's rocket fuel for metals. Now, in terms of positioning, I want you to hold two ideas at once. First, yes, there have absolutely been moments where concentrated forces tried to cap silver and suppress its swings. That's a documented pattern. Second, real-world institutions aren't static. They adjust, they hedge, they evolve when the data changes. So don't get stuck in a single fixed narrative. Watch behavior. For example, when you see repeated price hits that fail to break the trend, it often means strong hands are stepping in. Sometimes those dips aren't designed to kill momentum, they're aimed at grabbing a better entry. And sometimes, amid the noise, the market gives you a signal. Think about those odd moments, a trading platform glitch, a price feed delay, a sudden technical issue, and right in that moment, silver makes a sharp move. Coincidence? Maybe, but the takeaway is the same. Thin liquidity equals violent moves. These markets can snap fast, which brings us to the real bottleneck, physical supply. Paper contracts can multiply. Actual metal can't be conjured. Industrial users don't care about Fibonacci levels. They care about receiving material, hitting timelines, and keeping machines running. And when supply tightens, price becomes the filter. That's why silver can go from ignored to unavailable faster than people think. Let me give you a final cliffhanger. If the next wave is driven not by investors, but by industrial buyers scrambling to lock in supply, then everything changes. Headlines change, premiums change, terms change. That's when you'll start hearing about back orders, minimum buys, delayed deliveries, and that's when people who were waiting realize they're now priced out. So if you want to stay ahead of that turn, build now, while the process is still clean, still accessible. And yes, if you're after the deeper data, the off-the-surface stuff, that's exactly why we're building a private research track, a dedicated team, no noise, just advanced updates for people who want to move with context. Now that you understand why bank stress is just the opening act and why policy fallout is the main show, let's move into the next part, the one that hits home for you, access. One last point before we move on, because this is where long-term wins and losses separate. There are two types of people in a metals bull run: spectators and builders. Spectators refresh charts, feel emotion, and freeze. Builders follow a boring plan, stay consistent, and become unshakable. If you're a builder, you already know the truth. The best opportunities rarely show up when you feel confident. They tend to appear when you're a little uneasy. So here's my ask for you today. If you've been stacking regularly, share what routine worked for you. Was it weekly, monthly, only on pullbacks? What helped you stay on track? That one comment might be the reason someone else doesn't give up at the worst moment. And if you're just starting out, begin with a single ounce today. No rush, just consistency. Now, let's go to the part no one really wants to discuss. What happens when price isn't the main obstacle, but permission is? See, early in a bull market, the biggest challenge is belief. You're buying when people think it's pointless. Later on, the challenge becomes access. You're trying to buy when supply is thin, demand is high, and the system starts closing ranks. And yes, systems know how to protect themselves. We've seen it before. In the banking panic, the trading halts, the bailouts. In the emergency measures with soft names that mask hard consequences. When the pressure's on, rules bend for the powerful and tighten for everyone else. Now, people love the dramatic version of the story. Big banks short the market, they blow up, government steps in. Feels like a movie, right? But the real risk is quieter. It's when the system uses policy, compliance, or security as excuses to slow your exit. And you don't have to imagine it. It's already happening. Here's how it shows up in real life. You try to move money to buy metals, and suddenly your bank wants verification. They freeze transfers, they demand calls, they delay, and they say it's to protect you. And yes, scams are real, but blanket rules don't feel like safety. They feel like control. And if too many people try to shift real capital into tangible assets, the system has every reason to resist, because bank deposits fuel the machine. When money exits, pressure builds. So will it get harder? I think so. Not because there's a villain twirling a mustache, but because incentives shape behavior. Now pause. This next point matters. Most of the time, the system won't ban something outright. It doesn't need to. It just makes it harder, slower, more expensive, more frustrating. That's enough to keep most people passive. And when that doesn't work, there's always taxation. Tax law can act like a soft ban. It keeps the door technically open, but raises the cost so high the average person can't enter. We've already seen this play out in jurisdictions where buying metals triggers added fees that push your real cost well above spot. And when that tax structure becomes the norm, something shifts. The secondary market starts baking in scarcity and tax avoidance. In other words, physical trades at a premium that isn't just dealer markup. It's baked-in structural friction. That matters because it means anyone who bought earlier, before the taxes, before the gates, holds an edge latecomers won't get. And this is where the conversation gets real. If you know you want exposure to metals, why wait until it gets harder? I'm not saying go all in. I've never said that. Diversification has its place. But a small, regular, patient plan will always beat a last-minute scramble. Because the longer you delay, the more likely you hit one of two walls. You get priced out or discouraged by roadblocks. Neither helps you. Let's add another piece to this: affordability. When silver was cheap, people could build real stacks without breaking their budget. But as prices climb, the amount the average household can stack naturally shrinks. That's just math. So the later you are in the cycle, the smaller your window. That's why early action matters. Not to beat others, but to beat the future version of you that will wish you had acted sooner. Now, for those asking for something uplifting, I've got you. If you want to hear actual stories of how people used silver to build wealth, pay off loans, or time the market right, check the link in the description. It'll take you to a separate channel we're growing, focused on stories like that. Go subscribe and see what's possible. Back to the main thread. Where does this all leave us? We're in a market with solid momentum, strong macro drivers, and a shifting psychological landscape. The question is no longer, do I believe this is real? The new question is, how do I stay focused without letting my emotions run the show? Because here's the truth, the market will test your mindset. When prices rip, you'll fear missing out. When they drop, you'll fear you were wrong. And when they go sideways, you'll feel boredom and want to quit. That's where your process comes in. Your process could be as simple as a recurring buy schedule, weekly, monthly, whatever fits your budget and your nerves. The point is to stay consistent and avoid the two killers, chasing spikes and panic selling dips. Now for the final twist, the part few are ready for. The biggest moves in this cycle might not come from more people buying coins. Sometimes the biggest moves don't come from retail investors buying coins. They come from capital rotation. Think about the bond market, trillions locked in assets that pay a yield on paper, but bleed purchasing power in real terms. When real returns turn negative, that capital looks for a way out. And when it finds one, gold usually takes the lead. Then silver ignites. Then miners and related assets start moving in ways that catch people off guard. And by the time the public wakes up, they're usually late. So if you're here right now, you're already ahead of most. Now, let me say something that might sound blunt, but it's true. A lot of people talk about metals. They cheer them on, share the memes, quote the statistics, but when it's time to actually hold them, they don't. They hesitate. Then they watch price rise and complain it's too late. Don't be that person. If you want exposure, build it quietly, steadily, without drama. And if you've already built a position, protect it with clarity, not fear. Now, let me shift gears and talk about the membership side, because many of you have asked for deeper insights. We've set up a members-only research track. That means more data, more charts, fewer distractions, a dedicated team helping us go deeper, not wider. You'll find the join button in the description, along with access to the premium WhatsApp feed for more direct updates. Quick community note, if you've been successful, whether in metals, investing, business, or just stabilizing your finances, drop your story in the comments. One sentence is enough. You never know who it'll encourage. Progress is contagious. Let's now tackle the big fear that always comes up when metals run. What if the government steps in? People jump straight to confiscation stories or historic extremes. And yes, ugly policy has happened, but today's tactics are usually more subtle and far more effective. They use friction, they use paperwork, they use limits, audits, reporting thresholds, rules that seem fine one by one, but feel suffocating when combined. That's what you should watch for. And no, you don't need to stress over it daily. Just understand that environments shift, and if you wait too long, even a basic purchase can become a logistical nightmare. Now zoom out with me. Why are metals moving? It's not magic. It's not a shadowy cabal pulling strings. It's incentives. It's consequences. Governments run deficits. Debt piles up. To manage that debt, they push rates artificially low. But when rates stay below inflation, purchasing power erodes. And when that happens, people start looking for exits. Gold and silver sit at the center of that cycle. Add in geopolitics, resource nationalism, industrial shortages, and you've got a cocktail built to support the metals. That's what you're seeing play out right now. Now let me be absolutely clear. There will be corrections. There will be red weeks. There will be headlines screaming collapse. There will be well-dressed analysts on TV calling it a bubble. That's all part of the process. But in the end, the long-term trend follows the math. And right now, the math does not support currency stability. So what should you do? First, if you're just getting started, don't let rising prices scare you off. Bull markets never wait for your comfort. They climb a wall of worry. Second, if you've been here a while, don't get cocky. A strong trend isn't a promise of straight lines. Stay focused. Third, keep your eye on policy, especially interest rates and central bank tone. When monetary policy loosens, metals tend to surge. When it tightens, they pause. Right now, policy is still leaning toward easing. Now here's your retention level warning, because this is where people lose money even when they're right. If silver runs hard, emotions spike. You'll be tempted to make fast decisions, to sell it all, or worse, to buy the top in a panic. Instead, set your framework now. Are you stacking for security? Are you trading for gain? Or are you blending both? If you're stacking, you don't need to time anything. Your goal is peace of mind. If you're trading, your job is managing risk, not clinging to a belief. And if you're doing both, split the roles mentally. Keep your long-term core untouched. Actively manage your trading portion. That simple separation can prevent a mountain of regret. Now, cliffhanger number 2. As prices rise, the question shifts from should I buy to what can I even afford? That's why I keep hammering the importance of early accumulation. In the beginning, you can stack full ounces. Toward the end, people are scraping together fractions. Don't underestimate how quickly that shift can happen. Let me end with something grounded, something real. If metals keep moving higher, it won't be because everyone became a silver or gold expert. It'll be because confidence is leaking from the system, and gold and silver are the universal symbols of distrust. If that's where we're headed, you want to be in position before the crowd shows up and before the friction begins. So here's your simple roadmap. Subscribe if you haven't already. It's free. It helps you stay in sync. Check the description for premium research links, including the WhatsApp feed and members-only access. Drop OG John AG in the comments if you support what we're building. And answer this: gold, silver, or miners in the next 12 months? What's your bet? And what's one lesson you'd give to a new stacker today? Because this comment section isn't noise. It's signal. It's memory. It's a way to help each other stay calm while the system tries to shake us loose. Take care of your stack. Take care of your people. And I'll see you in the next one.